Welcome to Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. Disney making it official. CEO Bob Iger is handing over the reins to Josh D'Amaro. He's the head of the company's parks business, and D'Amaro has a tall task ahead. While the parks business has powered profits, the stock's been cut in half from its 2021 high. Also, Palantir soaring ahead of the open as earnings handily beat Wall Street estimates. The software company's guidance also blowing past expectations. It has been a little bit of a rough road for the stock since late last year. It's fallen alongside other software stocks, but today's move puts the AI trade back front and center. And Elon Musk consolidating his companies, putting SpaceX and xAI under one roof. That combination values SpaceX at $1.25 trillion. It could pave the way for a massive IPO later this year. It also raises the question whether Tesla could eventually be folded in. A changing of the guard at Disney. The company's officially announced that Bob Iger's successor is Josh D'Amaro, the chairman of Disney Experiences. He's going to take over the House of Mouse next month. Joining us for more is Geetha Ranganathan, a Bloomberg Intelligence U.S. media analyst. Geetha, it's not a surprise here, right? We've sort of had this drip that this was coming in recent days. But what do you think of D'Amaro as the choice? And I think, there's some questions about whether it's going to stick this time, because this is the second attempt at putting the head of parks in charge of the company.
Yeah, absolutely, Julie. Thanks so much for having me. Yes, this has been a long time coming, but I think this time things are a little different. I think Wall Street now realizes the importance of the parks business. I think it was a little bit underappreciated last time around, and we've really kind of seen the whole composition of the Walt Disney Company change. I mean, this is a great portfolio of assets. It used to be mainly a cable network company with a great film studio division. And there were some theme parks, but that has completely changed. I mean, just a few years ago, theme parks were about 35% of profits. Now they are about 60% of profits. So there's, it's very, very clear that, parks are going to be the main profit engine for this company going forward. And I think having Josh D'Amaro kind of take charge here really kind of underscores the importance of that division and just tells us how important the strategy for parks is going to be going forward. I think this time is different also because, they finally, I think, got a handle on the streaming business, which was what the problem was when Bob Chapek took over the reins last time. And I think, though they do have a good strategy in place, and having Dana Walden now as the chief creative officer should kind of keep that engine running too pretty well, Julie.
I was surprised a little bit by the timing of this, Geetha, that it's effective March 18th when the company has its annual meeting, because there had been talk that Iger would finish out the year. Were you surprised by that? And what is that? Is that sort of a signal that Iger's ready to step out of the way?
I think he finally is ready to step out of the way. I mean, he seems to even signal that he wants to do that so that the new CEO has breathing space, can kind of figure out his own path forward and his own strategy. Because last time, remember, he was criticized for kind of lingering on as Bob Chapek tried to find his way. And that might have eventually kind of, ruffled some feathers, caused some friction. We really don't know what happened. But I think this time he really kind of wants this clean cut, Julie.
As you mentioned, the other sort of main contender for this job, Dana Walden, gets a new title today too, President and Chief Creative Officer. And she really is viewed as someone who has deep ties to Hollywood's creative community. Is this title enough to get her to stay at Disney?
I think it is. I think she also realizes the importance of the parks business. I think naming her as CEO, yes, it would have been great for, the creative part of the business. I mean, Disney at its core is really all about telling stories, and she knows how to do that very well. But when it comes to experience at the parks, obviously she doesn't have any. So I think she understands that too. Having her, I mean, this is a historic role. Disney has never really had a chief creative officer before. So I think it definitely elevates her kind of, I think should definitely keep her in that position, and she should probably stay on, hopefully.
And then I guess my other question is, what does D'Amaro need to do to help the stock break out of the doldrums? It's like 4 years now going on where we've seen mostly sideways movement from Disney.
Yeah, I think this up and down with the domestic parks. So we've kind of seen, attendance really kind of go up and down quite a bit. It's bounced around. We saw that huge surge post-pandemic, but then the past few quarters, we've kind of seen, macroeconomic concerns. We've seen softness from international visitations. We've seen competition from Epic Universe. So there has kind of been this perfect storm a little bit, and then now you have the weather and all of that kind of playing into, lower leisure travel. But I think what is really good in terms of Disney is, yes, it's not a linear path. I mean, you're going to see a lot of lumpiness. You're going to see a lot of volatility quarter by quarter. But then if you kind of just zoom out and look at the picture long term, they have all of the growth drivers in place. So remember, they do have the 60 billion capex investment in the parks business. The cruise capacity is going to double. And Julie, as we just look even to fiscal 2026, I mean, 40% of the growth in parks is going to come from new cruise capacity. And so I think as we kind of see that reflected in the numbers, the valuation, I think, we are going to see a re-rating of multiples. It's just going to take a little bit of time to play out. And of course, the other big wild card is going to be streaming. As soon as they kind of show greater pricing power, more streaming profitability, higher margins, again, that should drive multiple expansion as well.
I mean, I've been enjoying Wonder Man as of late on Disney Plus, but I was already a subscriber, so I'm not making them any new money. The other wild card, it seems to me, is the consumer here, Geetha, because as you well know, it ain't cheap to go to those Disney parks. Disney cruises, I know cruises across the board, not just at Disney, the selling point is the value that they say people get on those vacations, but how vulnerable is Disney to particularly lower end challenged consumers here?
Yeah, I mean, there's always that vulnerability, Julie. I mean, this is a cyclical business. There are going to be some ups and downs. But I think overall, they are very well diversified, even in their parks portfolio. Yes, there's no doubt domestic parks are a huge portion of that parks business. But then, of course, you again have that diversification with the international parks. Remember, there is this huge expansion that is happening internationally. In fact, on March 29th, we have the World of Frozen opening in Disneyland Paris, which basically doubles the capacity of that second Disney park there. So, they're doing a lot of different things. Yes, you are going to have a little bit of bumpiness, but I think overall, as you kind of zoom out and take a step back, they are in pretty good shape as well.
Geetha, thank you so much for hopping on here with quick reaction to that breaking news. Appreciate it.
Thank you.
Of course, that's not all that's going on this morning. We have a lot of earnings to get through, but as we look at stock futures, we see a mixed picture. NASDAQ futures leading some gains. NASDAQ 100 indicating a gain of about 0.5% at the open. S&P futures showing a gain of about 1/5%. Dow futures very slightly lower here. And in the thick of earnings season, as we've talked about many times, it tends to be more of a individual stock-driven move. So let's talk about some of them because we've got some really interesting earnings movers this morning. The headline for PayPal, even though the shares are down because of earnings, the headline is the company appointed a new CEO. Enrique Lores, remember of HP, will be replacing Alex Chris. The CFO of PayPal is going to serve in an interim capacity until Lores takes over on March 1st. But the background here, fourth quarter earnings per share missed estimates. Their full year transaction margin dollars, that's how much they earn from processing transactions after expenses, will show a slight decline from last year. The shares are plunging. Let's talk about Pepsi. It's cutting prices 15% on snacks. It's going to reduce its product portfolio by 20% in the first half of the year. Meantime, fourth quarter profit beat estimates, and the company announced a $10 billion buyback authorization, those shares slightly higher. Merck shares are under pressure. The 2026 forecast for profit and revenue was a bit below estimates, in particular Gardasil HPV vaccine. Those sales under pressure, down 35% on waning demand in China and some of those changing vaccine recommendations in the U.S. And finally, Pfizer shares down about 5%. Fourth quarter revenue beat estimates on the strength of older drugs. The full year revenue forecast, we should mention, was unchanged with the midpoint slightly below estimates. And remember, the company's been making a lot of acquisitions. It bought Metsera last year for $10 billion. Today, it released data from one of its obesity drugs under Metsera, showing up to 12.3% body weight loss versus a placebo at 28 weeks. What does that mean? It means a monthly shot could be possible. So something, though, that it looks like there's not a lot of positive reaction to at the moment. I'll be speaking with Pfizer CEO Albert Bourla later in the day. And let's talk Palantir also, because that's giving investors something to cheer about. The software company forecasts 2026 revenue well above Wall Street expectations, projecting a 61% jump in revenue to about $7.2 billion for the full year. Here to give us his takeaways from the results, Yahoo Finance tech editor Dan Howley. So Dan, it's very interesting at Palantir because for a while it was mostly relying on government revenue, and the line was that it needed to get more commercial. Seems to have done that.
Yeah, they really have. I said 61% revenue growth projected for 2026. That's year over year versus 2025. But for this quarter, they saw U.S. revenue grow 93% year over year. Commercial revenue was up 137% year over year to about $507 million. And then obviously government revenue was up as well, 66% year over year to $570 million. They also said that they saw revenue grow for this particular quarter 70% year over year to 1.41, give or take, billion dollars. So obviously a very good quarter for Palantir. And it came after, the stock had a big sell-off towards the end of 2025, early 2026, basically since their last earnings report. All around the fear of an AI bubble, whether this is going to succeed. Michael Berry obviously had a note out saying that he had bearish sentiment on it, well, more than bearish sentiment on the company, and that really the big X factor for it, the kind of forward deployed engineers weren't really a long-term kind of sustainable growth pattern for them. But clearly they performed this quarter, and they believe that they're going to continue to perform going forward.
And Alex Karp, of course, always very outspoken on these conference calls. What did he say? It was cosmic something? The
results were like a cosmic reward for investors or something along those lines. Yeah. He likes to pontificate in his notes and his public appearances, and obviously in his kind of reaction here to the numbers. I think one of the big things out of Davos was him basically saying, yeah, I don't know if I necessarily should be doing this, but I'm doing it, going out and talking. He says that employees tell him to stop doing that as much, kind of maybe fade into the background and not be as active out there. He had a kind of big to do at the New York Times Deal Book Summit late last year as well, when he was on stage. So yeah, he likes to make these kind of grandiose statements, but clearly they're backing it up from these results now.
They are. I will say just quickly, I know there's been some internal talk about the company's contract with ICE, especially over the past month or so. Did he talk about that at all?
Yeah, I mean, that's something that has been just an ongoing issue for them. Whether or not their technology should be used by ICE as its own organization. He's backed that up in the past, basically saying that they work with the government. They try to ensure that there's no misuse or anything along those lines. But this has absolutely been something that has come under fire a lot more now, even though it was previously under fire for being used by ICE. So, I think they're going to continue that moving forward.
Dan Howley, thanks very much. Appreciate it. Coming up on Morning Brief, we'll talk about how we are thinking about the AI trade, especially given those Palantir numbers. We'll count you down to the opening bell. Nasdaq futures are pointing higher as investors remain focused on tech, with a slew of big tech earnings coming up this week. With me, BlackRock's Global Chief Investment Strategist, Wei Li, here with me in the studio. It's great to have you here.
Very happy to be here.
So we were just talking about Palantir, which seems to be almost its own entity within the AI universe. Mm-hmm. We've got Amazon and Alphabet coming out later this week. But it feels as though after the huge surge last year in spending plans, enthusiasm, that we've entered a different phase in the AI trade. How are you thinking about it now?
I think that's fair, because if you look at the last 6 months or so, tech was going sideways. It didn't go anywhere, but there is a huge dispersion underneath the surface. You look at during the same period, the gap between software as a service and semis, it's 60% in performance, the difference between the two. So there is definitely greater differentiation within the AI ecosystem. But more broadly, I would say though, earnings are still quite strong, and because price hasn't gone anywhere, in terms of valuation attractiveness, it has become more attractive, but we just need to be more selective. So, thinking about the infrastructure layer that we favor, look at the likes of the hardware, compute, and chips as kind of the selective sub-themes that we like within AI versus software, perhaps a bit less in favor because it's being disrupted a little bit more. But the bigger picture is that, we in our global outlook talk about how we need to see new revenues being generated to support the significant capex spending commitment that these companies put out there. So it's not just about kind of taking a greater share of the same pie. The pie needs to grow. So over the medium term, we need to see companies, hyperscalers, actually kind of thinking vertically, applying AI to other sectors, pharmaceuticals or financial services.
And when you're looking at the tech plays, the various subsectors, so you must be scrutinizing the growth trajectory, but also I'm curious how closely you're looking at balance sheets, if that has changed, or if you think that's something investors really need to focus on, given the enormous spending needs.
That's right. Actually, to your point about this is a slightly different phase in AI, it can be said about kind of the evolution of balance sheet as well, because up until now, a lot of these companies were able to fund their spending from their huge pile of cash, free cash flow. And it has been somewhat really kind of easily kind of taken by markets. But because we're at this point where spending is still happening and we're talking about similar level of capex for this year compared to last year, but revenue will take some time to come through, and the time gap between the spending and revenue creation means that we're going to need to see more leverage, which is why companies are going into the credit market to issue debt to fund their capex commitment. And this is a bit different because markets then start to scrutinize a little bit more and say, okay, what is your starting point? Can you afford to issue that? If you cannot afford to issue that, maybe you issue equity, which is what we saw in Oracle recently, right? So I think greater scrutiny around the health of the balance sheet is indeed a characteristic of this phase of AI. But the good news is that compared with the 2000, the starting point of these companies are so much healthier. They are issuing that from position of net cash rather than position of net debt. So it will be a while yet before we look at the balance sheet in aggregate and say this is very worrisome.
Gotcha. The other thing I wanted to ask you about is we tend to speak a lot about the AI trade in the US, but you're a global strategist. And at the same time, we see this trend of more interest in international markets that really started to rise last year, but seems to be persisting. So how are you, how do you think investors should put those two things together? Think about the AI trade, but not exclusively in the US.
I think there is definitely diffusion and diversification to be considered from an AI implementation perspective. Last year, South Korea equity market almost doubled, and it's because, number one, valuation, but number two, also because of the concentration of the AI play in its equity market. You look at Chinese equity market last year with the DeepSeek news, that has certainly also helped to kind of support sentiment towards the market. So AI is definitely a global theme, concentrated in the US, but as we think about kind of not just the build out, but also the application layer, this is where international market looks a little bit more interesting compared to before. Even in Europe, I'm based in London, I speak to investors and clients all across Europe and globally as well. In Europe, people complain about, okay, it doesn't have a lot of exposure to AI, is it going to be left behind? But actually sectors, traditional sectors like financial services and healthcare, they are ripe for disruption, and investors are looking forward to kind of thinking about what AI can do to those particularly thought of as traditional sectors in Europe. So globally, there are sectors that can really benefit from application of AI. We're seeing productivity boost coming through on a sector basis, and I think that would drive the next phase of earnings growth.
And you think even in a market like the Kospi, like South Korea, where we've seen all that upside, that there could potentially be more upside from this trend?
Well, if you look at the relative performance of emerging market over developed market, you look at that ratio, yes, it's rallied last year. It rebounded and outperformed developed markets last year, but we're starting from a multi-year, almost a decade of underperformance, right? So here, it's also closely tied to the dollar. If the dollar stays at the current level, maybe even weaken a little bit, that gives the incentive for capitals to perhaps go outside of the US to seek international opportunities. But here I would say really be selective rather than across the board, because at times of transformation driven by AI, it's not a rising tide lifting all boat. It's creating winners, but it's also creating losers. So really thinking about being very selective, which layer of AI do we want to have exposure to?
I also wanted to ask how rates fit into this picture. I mean, that goes back to the balance sheet. It speaks to the willingness to spend of some of these guys. Do you think we're getting 3 cuts here in the U.S. this year, or what's your outlook now that we know Kevin Warsh is going to be in charge of the Fed?
Well, markets are looking at 2, and it's not starting until second half of the year. We think that sounds about right. I would say that like people look at Kevin Walsh and say, is he dovish? Is he hawkish? We actually think that framing is misplaced, is missing the bigger picture, which is actually how is he going to manage pressure to cut rate in the context of the broader economy and in the context of the broader environment. Here, the good news is that actually labor market is softer than the actual economy. This week we're not going to have the NFP because of the partial shutdown of the government, but the big picture is that we have been in this no firing, no hiring stasis in the US labor market for a while, and one of the Fed's mandate is maximum employment. So if the labor market is somewhat soft compared to before, it gives them the macro cover to cut rate without it being like a huge political debate. And here the combination of actually the economy seemingly stronger than the labor market. You look at yesterday's ISM data, which is stronger than almost all the economists' forecasts. The combination of a strong economy and a slightly softer labor market, and what this means for the Fed, given its maximum employment mandate, together with inflation, of course, actually paints a picture of risk-on environment for assets, because the stronger growth supports earnings, and the rate environment, it's going to be manageable, even though term premiums should go higher, and equities are in a good position in this environment.
Well, thank you so much for coming in. Always great to see you. Thank you.
Thanks for having me.
Coming up on Yahoo Finance is Opening Bid. Our executive editor, Brian Sazzi's joining us now. He's got a tie on today. That means he's ready to go.
The suit indicator, Julie, means this. For me, a couple things. CEO changes, big stock market plunge, or big stock market surge today. It's CEO changes, PayPal, new CEO, Disney, new CEO, Palantir earnings, which I would quantify as quite big. And then, oh yeah, Julie, we're going to end Opening Bid with an interview with Snowflake CEO, who just dropped a $200 million deal with OpenAI. So lots going on with that company.
There you go. When CEOs are moving around, you put the tie on. You're auditioning. I get it.
Julie,
you're auditioning.
I'm putting on a sweater.
I know you're looking for a gig.
Yep. No, I'm not looking for a gig. What the hell are you talking about? No, I'm just looking for news, Julie. Stop it. Go to break.
That's it for Morning Brief. Opening Bid is next.